Good afternoon, everybody. Welcome to another webinar from Business Vision. I'm Mark Lawson, the Director of Business Vision, and today we're just going to be going through Cashflow Freedom, so a relevant subject for the moment. So I hope you're all well, hope businesses are starting to pick up a bit. As always, the meeting's probably going to take about an hour with questions and answers at the end. Typically, that will overrun by about 5 or 10 minutes, so we'll still get some questions in. However, it's still worth at the bottom right of the presentation, you should have a little chat box where you can put questions in, and I can go through those at the end. If we don't get time, then I will come back to you individually. So brilliant. So this is the second of the webinars we've done, and the plan now is to keep doing them on different subject matters. Those of you who have been with us as clients for a long time will know that a few years back we've done hundreds of seminars, live seminars. So we're now just moving on to the webinar arena because of circumstances, but covering some of the same topics as we used to cover then, which is all about growing your business and hopefully making cash and spending less time doing it. So cash flow is basically lifeblood of the business, and increasingly so at the moment. Xero bookkeeping software, they produce small business insights yearly, and the latest one they've got says that on average 52% of small businesses were cash flow positive in any given month in 2019, which basically means nearly half weren't. So out of all the businesses still going in 2019, this is obviously before coronavirus hit, so just normal day-to-day businesses, even then only half of them had more money actually coming in than going out, which is staggering. They also highlighted that invoices that said pay within 30 days were typically paid on average in about 39 days. So even with that, slightly worrying if you're running a business and people are paying you late, although to be fair, 39 days is probably slightly better than I anticipated. So that's insights from Xero. And I say today is really just going through how we're going to get you back into or keep cash positive. So I'll just run through the agenda. So initially, we're just going to be planning for what if. So what may happen, how do you deal with it? And we're going to use a little tool we've got called the growth equation software that we use with businesses when we do consultancy, and just give you a guide of how you would plan for those. We're then going to look at how to increase money in, how to increase sales. And at the same time, we'll then look at lowering the cost of your sales. So obviously, cash flow ultimately is money in, less money out. So we're going to look at increasing money in, reducing money out. We'll then have a look briefly at where did the cash go? That's a common question that I get asked, and we'll try and explain the difference between profit and cash flow. Cash flow is actually more important. And then we're going to go through, very briefly, because this is a big subject, we're going to go through budgeting, forecasting, and how to look at your profit drivers once you've got those in place. We're also then just going to go through the next steps you should take. So a little bit of an action plan, because coming along today is great, but you know that at the end of the day, information has to be supplemented with real action, your end, to do stuff. So we're going to give you some ideas on what you can do, quick, simple actions, and also how we can help. And importantly, which is unusual, we're going to be going through, in most cases, how we can give substantial help on cash flow without it costing you a penny. So I'll tell you how that can happen at the very end. So stick around for that. And then, as I say, if we get time, I'll deal with questions from you. If not, I say, then I'll come back to you if you put questions in the thing anyway. Okay, so let's just look at what would happen with a tougher economy. And without being too doom and gloom, the situation at the moment is really just getting over the health crisis, the health effects of coronavirus, there is a good chance, based on what most people are saying, that the economic fallout from that is still going to carry on for some time. We know that the government have ploughed, loads of money into helping businesses, so that's going to have to be clawed back somehow in the form of taxes. And I also think it's going to take a while for consumers and businesses to get confidence back. So there's still a year or two, in my view, of tough economy, deep recession to get through. So we'll be looking at that. And what could be happening, hopefully not all of these things, but this is just an example of some of the things that could happen. Your existing customers might just simply stop buying. It might be something they buy when times are good, but they stop. So you've got less customers. You might get fewer inquiries or leads. So your marketing might be producing fewer inquiries or leads. You might get less of those people who are inquiries or leads actually buying. So the conversion rate from interested people to actually people buying might reduce. Customers might come back less often. So part of keeping your business going is about getting existing customers to come back more frequently. And that applies to all businesses. A lot of businesses think that that isn't something they need to look at. They're always looking out for the next new customer. But getting the existing customers to come back, very crucial. Most businesses, practically every business can do that. Unless you're a funeral director, I think that's a good opportunity. Customers might come back, but they might then spend less. So if people go into supermarkets, they might be spending less because times are hard. There might be competition in price from other people doing what you're doing. So you might find that prices drop either because other people's prices are dropping, or maybe you take the initiative and discount in order to get more customers. We'll talk about that later. There might be increases in cost of your materials and stock because your suppliers are also struggling and need to try and make a bit of extra money. And there may be increased wages, interest rates, and fuel costs, etc. So some or all of those things could be applying in the future. And we're going to just look through how we address those in order to help profit and cash flow. So first thing I'm going to look at is called the growth equation. So if you just bear with me, I'll just pull that up. And as I said before, this is basically a piece of software that we use with clients. It's still very top end in terms of it doesn't go into huge detail. But what we've got here is effectively all the key numbers of a business. So we've got a business that had 5,000 customers last year. They retain 90%, so only 10% disappear. They then have new customers coming from leads, 500 of those, and they convert 80% of those into buying customers. So we end up with 4,900 customers this year. We then basically get those customers to buy 6 times a year. Average price of what they buy is £100. And then out of that, we have to pay for materials and direct labour, which is roughly 60%. And we've got other costs of 800 grand. And that gets us a profit of 376,000. So, a good solid business, 3 million turnover, 376,000 profit. So at that stage, all going well. But if we just look at what could happen, and I emphasize could, with some of these things. So let's just say that obviously we know they start off with 5,000 customers, but let's say because of the recession or whatever, slightly more of those disappear. So we actually lose 15%. And only 85% customers stay with us for the next year. Let's say there's 250 working days in the year and we get 2 leads a day. Maybe that drops to basically just 1 lead a day. So we're now only getting 250 leads or inquiries, depending on where they come from. And let's just say that the conversion rate becomes tougher. So instead of getting 80% of those to buy, we get 75%. And we've said that they typically buy 6 times a year. This is on average. Again, maybe that gets tougher and they buy 5 times a year, and maybe instead of spending £100 a time, they feel the need to reduce that to £90 a time. Let's also presume that your suppliers want to put their prices up a little bit. So instead of 60% of your sales going on materials and direct labour, it's 62%. And we'll assume that overheads and other costs stay much the same. So what we can see there at the top is basically the old business was making £376,000. That, with just some minor tweakings that could easily happen to a business of this size, has now basically suddenly rocketed down to £41,000 loss. So with only a few minor changes, albeit I've changed every single direct key number, but not by dramatic amounts in most cases. With all of those things happening, we've got a very healthy business of £376,000, just suddenly dropping to a £41,000 loss. And just as important, if that business was looking at exit, the previous valuation, very roughly, this is just back of a fact packet, was basically 1.5 million. Effectively now the valuation of that business is negative. If it continues to make losses, there'll be no goodwill value for that business at all. So not only are they losing the profit each year, they've lost the value. So that's the sort of thing that we're basically trying to avoid happening, and trying to find out ways where each of those single events can basically be controlled so that we can do something with it. So hopefully that makes sense. Hopefully you could see the numbers on that. If you can't, just simply type into the chat, send me a copy, and I'll send you a copy of that final printout of those numbers. I say, I am aware that that's slightly scaremongering, but it's likely that at least one of those changes will be impacting your business over the next 1 or 2 years. Hopefully not all of them in the same dramatic sense. And bear in mind that as well as trying to stop businesses going down, addressing each of those things, even if things don't get worse, is still going to improve your business substantially. So those small changes negatively drastically affected profit. The good news is that small changes, increasing numbers, can drastically improve profit. So regardless of where you are on that level, whether things are disappearing or whether it's all staying the same, these things are absolutely still worth looking at. So let's look at the impact of sales dropping. So this is just basically less customers. And we'll just look at some of those key areas and see what we can do. So first thing we need to do is, how do we increase customer retention? So how do we get customers that bought from us previously to actually continue buying from us? Now, depending on the business, that can be very straightforward. So in a business like ours, accountancy, it's very clear that unless people deliberately say they're going, then they will be buying and dealing with us next year, because we do annual services that are required by law. You may be in a slightly different business, so you may be in a salon or a shop where basically customers will come back as and when they feel like it. So things we can do is we can under-promise, over-deliver, which is basically making your business better. I think that phrase is a little bit cliched. So what I'd prefer for you to think about is maybe over-promising and over-delivering. So actually do things that nobody else is doing and then do them even better than people are expecting. And that's tough to do because obviously we're all busy, but that will get you not only more customer retention, but it will also get you more customers. Know your customer, so find out more about customer, understand what makes them tick, understand what makes them buy. Implement a customer loyalty program. A lot of big businesses do that. Sky, for example, have a VIP program which is designed to make people think that they're top of the customer list. It's really just a cross-selling tool. But a genuine customer loyalty program where maybe they get better deals or they get offered things first would be good. Offer guarantees. Very few businesses offer guarantees, and it's a key element to actually getting customers to stay and getting customers to come to you for the first time. And guarantees is a subject that we've dealt with before, and it's really something you could talk about for a whole webinar, and I'm sure we will do that at some point. And with all of these things, I'm skipping through them. They are all big and difficult things to do, so we can help with these, but I'm not going to go into great details on how. Ask customers what they want. So customer surveys, great thing to do because it keeps you in touch. It finds out if anything's not working, but it also reminds them that you're there. Surveys, asking them, good. Invitation-only events. So again, maybe they get first dibs on something. Maybe when something's launching, they get that first. So invitation-only events and engaging on social media. So obviously a lot of stuff going on social media. You can keep in contact with them that way, either very informally with things like blogs and stuff like that, or specifically one-to-one. So a few ideas there. Hopefully you've got pens and pads ready to write notes when I say something really useful. So just for a moment, if you could just write down just the first 2 or 3 ideas that spring to your mind about how you might improve customer retention. Okay, next one. Once we've kept customer loyalty, customer retention, next thing is obviously to add to those customers, and that starts with leads or inquiries. And that will vary enormously from business to business. So a few ideas I've written down on that are build a strong online presence. Probably for most of us, that's going to be website. We do a marketing critique service that some of you may have experienced, where we will assess how good a marketing piece is for getting leads, because it is quite a proven science. And most people would ask us to critique their website. And I have to say that of the ones we've done, and we've probably done at least 50 website critiques, very few get above about 15 out of 100 as a marketing score. A lot of them look great, but as a tool to get new leads coming in and making inquiries, generally they don't tend to work very well. So there's usually huge scope for improvement on websites, as well as all the other online presences. Referral programs. So one of the best sources of leads are your existing customers. So rather than just wait for them to recommend people, is have a program of reminding them to recommend people, making it worth their while to recommend people, because people they recommend are also going to have higher conversion rates. Because if a friend recommended a restaurant to you, the chances are you wouldn't do that much inquiring. You'd rely on your friend's knowledge and opinion, whereas if you just came across an ad, then you wouldn't be quite so confident. You probably check a few things out first. So people recommended by your existing clients and colleagues are great. Attend networking events, probably not a lot of those going on at the moment, but there are a lot of online networking things shooting up instead. Hosting seminars, webinars, educational events, they're always good for getting people informally there, because attending a webinar is not particularly difficult to do, and it's also not going to be face-to-face selling, which is obviously the thing that tends to put some people off. They won't make that leap to move things forward, but going into a webinar, finding out a bit more information, they will happily do that if they're in the marketplace for what you do. And just business cards, LinkedIn, all of these things will just get you out there and become more known to people. Regular newsletters, blogging, so all of those things should be done. Newsletters, I think, should be done monthly. We have, I think, 3 different newsletters, but monthly something that's going out to your lead database, and maybe blogs as well. And then just generally more marketing. What we tend to find with businesses that we look at improving sales with is that they have 1 or 2 things that they do for marketing, whereas the reality is there are probably 20 different types of marketing, and within each type there are then probably 30 or 40 things you can do. And the key for getting leads is to do as many of those different types of things rather than rely on one thing. So if you're just relying on your website, you will get far less numbers of leads than if you were doing 10 different things if you were doing mail shots, email marketing, Google ads. And the key for successful business is to do all of them. Don't just do the ones you like or the ones that you think will work best. Do all of them, test them, and only drop them if they are definitely proven to not work. So more marketing for sure. Then how do we get those leads to basically buy from us? So we get them interested, they make some form of contact or inquiry. So the key thing there, I think, is training your sales team. That depends who your sales team is. If it's a real person in a live one-to-one situation, then one of the training things that works well is them knowing from previous questions and surveys what their objections might be. So what's going to put them off buying, and then get them trained up in how they would overcome that. Because if there are objections, deal with them at the sales meeting, and then hopefully the customer can move forward. Even if that's selling on the internet, the same thing works. You just make sure your website knows all the things that the customer needs to know that might stop them buying, i.e. do they do a guarantee? What happens if it doesn't work? Does it do this? Does it do that? All of that's answered somewhere in the sales process. You'll get more of them signing up. Unique selling point. So A, having one, and B, letting everybody know about it. In my view, most people who say they've got unique selling points, they are rarely that unique. A real unique selling point is you do something far better, far more different than every competitor. That will be a unique selling point. Often when you go on websites, you'll see things like we've got friendly staff and we've got 20 years experience. Those aren't unique selling points. They're useful, but they're certainly not unique because every website will say that. Alternative payment methods, certainly that's going to be relevant with the current recession. So people will need to have different ways of paying. If it used to be upfront, then obviously finding ways to pay monthly or whatever can work. Testimonials and case studies, as I said just now, businesses will tend to rely on other people rather than your business marketing to tell them how good you are. So case studies, testimonials, they're easy to get, and they should be basically splattered everywhere you do marketing. We have a great tool for testimonials. If you haven't got many, then we have a letter called Testimonials by the Dozen letter, which is really just a template letter. Send it out to all your customers or email it out, but better post. And that will, I guarantee, get you, hundreds. If you've got hundreds of clients, it will get you hundreds of testimonials. So if you'd like to see that, just put in the chat, Testimonials by the Dozen, and I'll get that to you at some point in the next few days. Free trial or money back guarantee. Again, they will help overcome objections. Most of us, when we are buying something, we need to know that it will do exactly what we want it to do. So a free trial will overcome that. And it's harder to send stuff back or return stuff after a free trial. And money back guarantees, so make it easy for them to experience it before they actually have to part with money, or they can get their money back. Online shopping is becoming more relevant in the absence of people being able to come into premises and so on. So, if you haven't been doing online shopping, that's certainly worth looking at whether there's a way to do that. We've seen that with restaurants. So a lot of restaurants have just basically shut the restaurant, but they're still doing home deliveries or click and collect. So they've basically reworked what they do. And there's nothing to stop them doing both in the future, and allow customers to book online. Now, all of these ideas, I say there are hundreds of ideas that could come under each of these. I'm just giving you a very small flavour. So again, just take a couple of minutes just to write down any other ideas that you might have in each of these headings as to how you could turn leads into customers. Just 2 or 3, just so you've got something to get going with after the webinar. Okay, next one, make more money per transaction. So for me, this is the one that's rarely looked at, and it's also for me the easiest to do, and it's also the one that makes you the most money quickest. Now, I suspect that a lot of people listening will be skeptical, and I understand that, and I'm quite happy to go through reasoning behind that. But it's a fact that typically increasing price will outperform on a percentage by percentage basis getting new leads by about 2 to 3 times. So 1% increase in price will usually get you 3 times more profit than 1% more work. So increased prices is definitely the thing to look at initially, but it's also the one that most people don't have much knowledge of how to do it, because they just see increasing prices as, I used to charge you £10, I'm now going to charge you 11. That's a very blunt tool. Without going into huge details now, all of these areas we're looking at, these ways of improving profit and cash flow, I basically keep a list of ideas, and if we add all of those categories together, I've probably got a list that covers 1,000 to 2,000 ideas, possibly more. And price increases alone, I have probably 200 or 300 ideas. So just going, it used to be £10, going £11 is one idea, and it's a fairly blunt tool because it's fairly clear to the customer they're just paying more for the same thing. And interestingly, without going too much off subject, within prices, probably at least 80 to 100 ideas all revolve around the psychology. So how it's presented. Most people buy emotionally, but most people selling think that they buy from a logical approach. It's not the way it works. So increased prices, definitely look at that. And similarly, as well as increasing prices, avoid discounting, because that's avoiding reducing prices. And we'll go through that in a little bit to show you exactly why you shouldn't be doing discounting. Put different products together. So it's what we call bundling. That works very well. McDonald's have basically made a mint out of that. So if you go into McDonald's, they will offer you basically a meal deal, which is the food, the fries and a drink. And although buying those 3 things together is slightly cheaper than if you bought them individually, their research shows that they would sell a lot less fries and drinks if they just sold them individually, because people wouldn't choose all 3 together. But once they see a bundle and a slightly reduced price, they will buy that, and they'll buy it even more if the person serving you asks if you want to go for a meal deal. So again, look at that. Don't need to discount the things added together too much. And that's one of the few occasions where you would look at discounting. Offer better payment options. We talked about that earlier. So you can basically charge extra by giving them better deals. So you don't have to give them the same deal and a way of paying over a longer period of time. That could be more. Upselling, cross-selling, obviously different versions. Again, McDonald's are a great advertisement for doing that. So if they're trained well, their staff should always ask you, do you want to go large? And that immediately gets you spending more money. You'll get a little bit more product, but there's far more profit on that extra. If you go into electrical stores, they will almost always try and sell you the warranty or insurance, which again is where they make most of the money. I did read somewhere that Currys made more money from selling their warranties than they did in the rest of the business. So upselling, cross-selling, ethically, obviously all of these things need to be ethical. We're not just trying to gouge clients here. And another one which works really well but can take a bit of thinking is different levels of service, different levels of product. So rather than just going, this is the service you want to buy, this is the product you want to buy, give them some choices. So rather than buy product A, we've actually got different variations of that, product A, B and C, and they're all different prices. That way, the people that haven't got much money will still buy something, they'll just buy the lower end. And those with loads of money might spend more than you would have probably sold something for if it was just one option. So loads of reasons why that works. So just have a brief think about what you could do to get the average value of each sale up. And ideally, not just by going, let's add 5%, because I say that is fairly blunt and it will get noticed by clients. Okay, so we've looked at all the sort of key elements of getting more money in, getting more sales. We'll just touch on briefly reducing costs. And I say briefly for that because if I had to emphasize which area to go on, it's always best to concentrate on increasing sales and cash in than it is reducing costs and cash out. The main reason for that is it's a lot easier getting increase in sales and it's harder to get costs down, but also money in sales, there's no limit to how high you can go. There is a limit to how much you're going to save on reducing costs. And it won't even be 100% of your costs, because if you get to that point, you will be not trading. So if you can get 5% off your costs, you're doing well. To get 5% on your sales is actually relatively easy. But things you can do here, early payment discounts. I did say earlier, don't discount. It is okay to discount if it's well thought through and part of you getting something in return. So I don't mind discounting if you get a referral, a new client from a client. I don't mind particularly if you actually get paid quicker and you give a slight discount for that, because that's going to make you more money in terms of saving interest and improving your cash flow. So discounts, if they're strategic and they're guaranteed to get you more back than you're losing, fine. Volume discounts. So again, if you basically say the more you buy, the cheaper it will be, that's fine. Loyalty discount, maybe, because that keeps customers coming back, ties them in. Stock control, obviously, with people buying less at the moment, it's more likely the stock's going to be sat around if you have stock for longer. So controlling that is more important. But also, I think in the current climate, you should be able to get your suppliers to deliver fairly quickly. Not always, obviously, if you're buying from China, not always easy to get that quickly. But if you can order stuff quickly, then it means you don't need to have too much stock. And stock is just money sat on a shelf. So stock control, minimize freight, review your suppliers. Obviously, you know, it is a buyer's market. And the good news about our businesses suffering in a recession is that our suppliers will also be suffering. So, you know, they will be open to deals. They won't be coming to these webinars necessarily, so they may be quite happy to do discounts just to keep the business. So, you know, a review of suppliers, just renegotiate the terms and reduce rework and wastage. This is probably the biggest area you can actually save money, because it doesn't mean you have to go out to anybody else and do anything. It's basically you just get more efficient. And the big problem with rework and wastage is it's very rarely recorded in such a way that you can see the effect of that in your accounts. So discounts don't get shown in accounts. They just really reduced from your sales. Rework and wastage don't get shown in your accounts. They're just more materials and more labour costs. So measuring those and getting them reduced is probably the one I'd start with. Again, when we've done research on this, depends on the business, but we can often find that profit can grow 10, 20% almost within weeks if efficiency is not very good. And most businesses' efficiency isn't that great. The bigger you are, probably the more inefficient you are. So have a look at that. And again, just spend a couple of minutes just writing down any thoughts you have on how you would lower your costs. Okay, I mentioned discounting just now very quickly. I just want to just go through why we don't like discounting, because it does seem to people that it's a quick and easy way of getting more customers. But I just want to show you why it can be disastrous even in a recession. So I've got basically a little table there where a business is selling 10,000 widgets or whatever. They're selling them at £100. So their turnover sales is £1 million. That's the top line. Their cost of sales, COS, that's their materials and labour, what they have to spend to do the sales. It costs them 60 quid per widget. So they spend 600 grand and they make 400 grand. And that is called gross profit. And that's used to pay the owner, to pay overheads, etc. Now, if they basically then said in a recession, let's reduce the price from 100 to £90, so they're still going to sell 10,000. So they managed to keep all their existing widget sales going, but obviously turnover sales has now come down to £900,000. So 10,000 widgets at £90 is £900,000. The big problem is that it's still costing them £60 to produce those 10,000 widgets. So their costs are still 600 grand, which means that their gross profit is now only 300. So that 100 grand they've discounted goes right to the bottom and it comes off profit. So that's 10% of your profit in this example. And the problem with that is most people's profit is usually rarely above or much above 10% of sales. So that single discounting, if you did it across the board, could just lose you all of your profit. Now, if we look at actually what losing 10% of customers would do, is that, yes, you've now only got 9,000 widgets being sold, but it's at the original price of 100. That still gets you 900 grand sales, so you don't really notice the sales effect. But what it does mean is you only have to pay to have 9,000 widgets made. So 9,000 widgets now at £60 reduces the cost to make it to 540. So gross profit only goes down to 360. So 10% less volume loses you 40,000. 10% discount loses you 100,000 in that example. Now, those numbers will vary slightly for your business, but I can guarantee that 10% volume drop will never lose you as much money as 10% price drop. It may be 2-3 times different, but it will never be worse. So always look at alternatives to discounting. And I can go through that with your business if you want to know what the numbers are. Okay, let's now look at where does the cash go. So what we're looking at here is a little bit about the difference between cash, which we call working capital. So it's a technical term, it's a Cantonese description of really just what's holding up the money compared to profit. One of the questions I mostly get asked when we go through accounts with clients is they're looking at the profit and loss account and we go, oh yeah, there's a nice big profit there. So maybe it's 100 grand. And the first question I get asked is, that can't be right because I haven't got 100 grand in my bank. And they won't necessarily have 100 grand in their bank. It'd be very unlikely because profit is not the same as cash flow. And I would argue cash flow is far more important because you can survive with no or little profit. You won't be able to survive for long with little or no cash. So cash comes first. Yes, you have to have profit eventually to make the cash. But in the short term, you could have decent profit figures, but no cash coming in. In some cases, you could even have cash going out. And in many businesses, doing more sales actually in the short term can cause you to need more money. So, it's quite easy to think, oh, if I go and get 10% more customers, I will have more cash. Well, eventually you will, but that may not be until you actually exit the business. In the short term, that could be increasing your working capital needs, which means you might actually reduce your cash balances or increase your lending. So we want to go into that in a little bit of detail because it's quite important to understand. But I say it is a question I get asked regularly. And the big problem, I think, with standard accounts is that it doesn't explain where that profit has gone to. You get a profit and loss statement, you get a balance sheet. An accountant can tell you where the profit's gone and why it's not in your bank on the balance sheet. But rarely do they do that. We actually do produce a where did the cash flow statement, especially if we do bookkeeping and management accounts for clients. So it can be worked out. And I think that's almost essential reading. Most businesses don't like reading the balance sheet, but where did the money go? So why haven't I got loads of cash if I've made profit is, pretty essential. Most businesses know what their profit and loss account will look like. And they're not that clear in my experience as to why it isn't just sat in a bank account somewhere. So another statement showing that would be really useful. But we'll touch on the basics. So this is a description of what we call working capital cycle. I think the general practicalities of this people are aware of. What it actually means in practice of cash flow and running a business might not be so well known. I've got two examples there because it is slightly different depending on whether you're a service provider or a retailer manufacturer. The big difference is a service provider will only be selling labour, so they don't have to buy materials. Whereas a retailer, corner shop, they have to buy stock in, and then they have to basically keep it on the shelves until somebody comes in and buys it. If you're a manufacturer, you have to buy the stock in. So let's say I'm a kitchen company. I have to get all my cabinets and work materials in. Then I've got to go out to the customer. Then I've got to fit it and do the work before I can even get round to billing the customer. So in the retailer example, effectively, the first thing that you tend to do is you buy the stock. And at some point, you're then going to have to pay your supplier for that stock. And if you're a manufacturer, you are going to have what's called work in progress. So that's basically, you've had to buy some stuff. You may have even had to incur some labour costs before you can get to a sale. So you have to do all that work before you can actually bill it. Same with a service provider. A service provider such as ourselves, we may have to spend 3 weeks doing a set of accounts, and only then can we bill it. But obviously during that 3 weeks, we're still paying wages. So that's work in progress. So then we get to the sales situation where we actually bill it. And in a lot of businesses, we still then have to wait beyond that to get paid. So it then goes into accounts receivable before it converts to cash. So that whole cycle of events can lose us cash. It will vary from business to business, but knowing what your working capital cycle is quite crucial for the reasons we're just going to show here. So this is what we call a cash conversion cycle. It's another way of looking at what we've just said. So this is basically a real example of a wholesaler. So day naught, they buy some stock from their supplier. The supplier wants payment 45 days later. Probably he wants it 30 days later, but he'll get it at 45. And then at some point, either the person we're selling to then says, I want some of that or whatever. We then sell that stock on to our customer, who will then obviously sell it on somewhere else. But that doesn't happen until day 60 in this particular example. So day 60 is when we can raise the sales invoice, but that customer is then not going to pay us for another 60 days. So money doesn't come in until day 120. Well, hopefully you can see from that description there that we've got a 75-day gap between when we're going to see the money in our bank and when it actually leaves the bank to pay the supplier. Now, none of that affects the level of profit. The profit is still going to be the difference between what we sell it for and what we buy it for. And that happens on paper. What this is real money into and out of a bank account. And that's why cash flow is a lot more important than profit, because this is real and this is affecting this example wholesaler's business in that every time he does a sale, he has to buy this stock and he has to spend money before he gets it back. Well, during that 75 days, he's obviously without the money. And if you think about it, if he's growing, so if he's doing more sales, that's just compounding that problem, because the amount of money he's losing in that 75 days is just getting bigger. So that's, I say, it's only an example. Your situation will be different, but it's important that you know what it is. And when we do annual accounts and when we do consultancy work with clients, we will go through the cash cycle. It doesn't always resonate that much because it's not something that businesses deal with day in, day out, but it's important for cash flow to get heads around that and to know whether you've got a positive cash cycle or negative. If it's negative, then you will have to look at that and see how you minimize that problem. Even if it's positive, making it more positive is still better because it means the money will be in your bank even longer. And this is a little graphic that we do send out to clients, particularly when we do consultancy, to explain the whole process of how cash goes around in a cycle. So you have assets, which can be cash, it can be properties. So if you're Tesco's, you're effectively using properties to make money, which is the superstores. From that, you then generate a return on that money, a profit. And then from that profit, you will effectively be generating at some point cash. That cash is then used for the owners. So it either goes out as drawings for a small business, dividends to shareholders if you're Tesco, and some of that money is retained to then buy more assets so that the business can keep growing and become more cash positive. So that's the general cycle, and we've listed there, might not be easy to see, but I can send you copies of this, the sort of drains and gains. So cash drains are obviously people paying slower. Cash gains are collecting money quicker. Cash gains will be paying your suppliers slower. Cash gains will be paying your suppliers slower. Cash drains will be them asking for it quicker. So all of these things are effectively a cycle, and it's important that we know what that cycle looks like in your business. So I'll just go through some ideas, and again, like the ideas earlier, this is just brief ideas. As I say, there are hundreds of things you can do. Hopefully this will spark some awareness of what those might be, but at least it's key areas. So first thing is, if you do invoice and then wait to get paid, create or review a debtors process. Debtors is the people who owe you money, receivables. So a process to make sure that you collect that money in religiously and as rigidly as possible. What tends to happen in businesses that send out invoices is that when cash is tight, they suddenly get, Jane in the accounts office to ring round all the people that owe money and chase them up. And some of those will pay, some won't. So the cash crisis goes away. Jane doesn't do anything then until the next cash crisis. Problem with that is it's hand to mouth. The other problem is your customers will recognize that if they can get you off the phone after the first call, you don't tend to come back to them because somebody else has paid. So process is absolutely important. Part of that process, which should happen daily, doesn't matter if you've got 800,000 sat in the bank, you still want to be chasing down people who owe you money. Next part of that process is to let customers know what the payment expectations are. And I think that takes place before you even do the sale. I think that takes place when you take them on as a customer for the first time, especially if you're going to be sending out invoices and waiting to get paid. And the conversation goes, I'm great you're interested in our stuff. We're, really excited to do work for you. But let me just run through our payment process. What we do is we expect to get paid 30 days from the date the invoice goes out. Is that okay? Now, the potential customer is going to say one or two things. He's either going to say, yes, that's great, in which case he now knows that that's how you work, or he's going to go, no, our policy is we pay 60 days. It's then up to you to go, that's okay, we can fit in with your 60 days, as long as it's religious, and we will amend our policy. Or you might go, it's 30 days, we don't deviate. If you want 60, then I'm afraid we can't do business. It's a shame. But strict, and let the clients know. It's no good letting them know how strict you are after you've sent the invoice out, because that just means you can have loads of phone calls and conversations. It's better to get it done up front. Any issues they may have with that should come out at the beginning. Qualify customers before offering credit. It's great when you get customers, but what we don't want to do is just take out anybody that's got a pulse and a wallet. We really want to be making sure that they're going to be able to pay us, especially if we're dealing with big ticket prices. So do credit checks. Don't just dive in to taking on customers. Do credit checks, get references, do company searches and get credit scores. And if you are a client, we can get credit scores on all limited companies free of charge for you. So just send us names within reason. Obviously, we don't want to be doing hundreds. If you want to know a credit score for a potential new customer, we'll search that for you and tell them whether they're good or bad. Stock control, we've mentioned earlier. Make sure that stock, make sure you reorder only when you need to reorder. There's no point having 50 items of the same thing on a shelf if you only sell one a week. That means it's going to be sat there on average for nearly a year. So only buy when you know you have to reorder. And if you can persuade your supplier to deliver almost tomorrow, then you can pretty much do that and have as little stock as possible. Stock on shelves, as I say, it's somebody else's money sat on your shelf. It's not in your bank. And increasingly, in the present crisis, we are finding that obviously if businesses are shutting down, then that stock's not going to be moving anywhere, during shutdown. So that's going to extend that lifespan as well. Even more reason not to have huge amounts of stock floating around. Monitor sales trend. So if you know what your sales trends are, then you can basically anticipate what you need to order and so on. That's obviously a big part of retail stores. So Marks and Spencer's will have a whole department working out what trends are coming, what fashion things are coming, and making sure that what they've got in the stores or online is only what they need to sell quickly, if possible. Another one that businesses tend not to follow, which I think's a bit of a failing, is to have a regular monthly drawings figure. So rather than go, oh, there's money in the bank, I can take a bit out, I can have a holiday, and then realise 2 weeks later that the VAT bills come, the corporation tax bills come, is actually treat yourself like all other suppliers, is have a regular amount that goes out regardless to you as a fixed figure. You then budget that personally in a personal budget. Nothing to stop you then going back to the business at some point, ideally when the figures have been produced and cash flow's been assessed, to say, actually, I would like a bit more. But regular amounts going out rather than lots of little ones. And what we tend to find, because it happens in our conversations, is if I say to a client who's just taking out bits here and bits there whenever it's available, they are always shocked when I say, this is how much money you've taken out over the year. So if I go, you've had 70,000 out, that means that cash is tight. They'll go, no, we don't spend 70,000. And then you go through all the little items going out, the private life insurance, their personal tax bills, plus the odd £2,000 when cash was, the bank balance was high, when they suddenly decided to get a new telly or something. Far better to go, it doesn't matter what the figure is because we can work budgets around it, but we want 5,000 out a month. That will see us fine. That's a £60,000 budget. And once we get the £5,000, a bit like a salary, once it's gone, it's gone. We know we're then eating into reserves that aren't budgeted for. So try and treat it like you're in a job. And finally, be aware that financing is not a dirty word. Financing exists purely to help your business. So things like factoring basically gives you money when your customers aren't. So consider financing as an alternative to just letting your bank balance drop. If you can avoid both, great. But financing is there for that very reason, is that banks know that businesses can still be profitable but not have money. And they're quite happy to lend profitable businesses because they know at some point it will all come back. They won't lend non-profitable businesses because they're lending effectively to subsidise profits, not cash flow. Okay, so that's cash flow management in terms of sales. The same should apply to looking at your accounts payable. So the things we can do there are just have a purchasing system. So again, basic things like let's get a quote, let's get the business owner to check the big quotes to make sure it's okay. Let's check that that quote is actually what we get invoiced for. Let's check that what we get sent is what we asked for. All those basic things. Let's check that what they're asking us to pay in terms fits us. And if we can, let's ask for extended credit terms. As I say, it is a buyer's marketing at the moment. So you should be able to get some sort of extended terms with most suppliers if you're genuine. So do that. Communicate with suppliers. So if things are tough, communicate. It's not an easy conversation, but far better to talk and discuss than just let it ride. Because the people that you can't pay are also in business, and they'll be having different thoughts than you are. So conversation and, where possible, negotiate. There are usually ways of negotiating ways through cash crisis, especially if profit's there, or if it's just no profit because of coronavirus. So a few ideas there just on dealing with accounts payable. And last sort of section is about budgets, forecasts, and profit drivers. So we'll go through that. Again, it's a big subject. So I'll just touch on it and deal with the key points, if that's okay. I'll just have a drink of water there. So what we're talking about with budgets and forecasts is your profit and loss account. Obviously, that's what most businesses tend to see and look at. I think having that annually is nowhere near good enough anyway, let alone in a crisis situation, in a recession. Needs to be formal profit and loss accounts prepared accurately monthly. And that can be done in-house. Sometimes it can be done through us or bookkeepers. It's not as expensive as you might think, but at least then you're going to know your numbers accurately within a month's grace. Too much can happen in 12 months. So you'll have your profit and loss. You'll also have information about your working capital. So you'll know what money's owing. We'll know your stock and work in progress. We'll know your suppliers. And you will then know what your cash cycle is. But more importantly, you'll know whether that cash cycle is getting better or worse. Because as it gradually gets worse, it's going to be eating up more of your cash and therefore is more likely to push you into problems. If it's getting better, then at least you'll know there's light at the end of the tunnel. So it's not just the working capital, it's trends. You'll also need to be able to budget for finance. So working out what assets you need to buy and whether you need to borrow for that. And cash flow. So one of the key things I think a forecast will do is look at what the prediction is for your cash balance over, let's say, a year or two, which is essential in the current climate to know, have you got enough money coming in on your estimates of what you're going to do, or are you going to need to borrow? But more importantly, you can also ask questions if the forecast is done properly, like, what if the sales are 10% less than I thought they would be? How big will my overdraft be then? And is that going to exceed my overdraft limit? So forecasting and budgets, I think, are crucial, I say, even in normal business days. And good businesses always do those. So we've already shown you that you can have profit and still go bust. We've also shown you that you can have cash now, but if things get worse, that could drastically change overnight. So budgets and forecasts will generally help you assess that situation and be able to then plan and take action where needed. Profit drivers and KPIs, again, big subject, something we do a lot of work with, is rather than just looking at sales and costs, we start to look at the things that are going to get you, particularly sales, because that's the area to target. And they're called drivers or KPIs, you may have heard them called. And that's really looking at what specific things or number of things are actually driving those sales. So for example, in our business, then part of that might be we're measuring a KPI of how many clients do we have, but also how many services do they buy on average. Things like that. A cinema might be what's the average ticket sale. A hotel might be what's the average number of rooms occupied any night. So, an empty room in a hotel is just wasted money. So every business will have a different set of KPIs, and I'd be very happy to go through those with you for your business if we haven't already. But it's working out what those are, and that will help you work out how to grow the sales and reduce the costs. If I just said you need to grow your sales by 100,000, it's very hard to actually work out what you're going to do. Whereas if I say you need to get the average price from £10 to 11, that's going to make it easier to work out what you do. If I say to a hotel you need to actually get more rooms filled, then that is a more specific thing, and that can be allocated to specific people within your team. If you just say we need to get more sales, chances are not much will actually happen because nobody will know what to do. And what will happen is they'll look back after a certain period of time to see whether they did get more sales. And when they realise they didn't, they'll go, oh, better luck next time. This is more reactive and proactive ways of getting it. So a big subject, as I say, that we're just very briefly touching on, but don't just look at profit and losses and just because that's really telling you what's happened in the past. Drivers will tell you what you need to get in the future, and they can usually be measured daily. Most of them, a hotel will know whether they're 90% full or 50% full every day. The profit might take another month to come through. So consider that, and that also will allow you to have a set of targets that you can make you and your team accountable for. And it also is something that we can work with you on how to get those numbers up. And we don't need to know, surprisingly, exactly how most businesses work. What we do need to know is what the drivers are, and we can help with defining those. But most drivers, there are usually similar ways of getting those types of drivers and KPIs up. So, we've done work with a waveguide supplier. They supply some form of engineering tools to people like the NHS. I have no idea what that is, but I have a huge number of ideas on how they can improve that operation. Okay, so hopefully there's been some stuff there. I know it's quite a detailed and in-depth thing, and some future webinars will take some of those ideas and look at them in slightly more detail. But what we need to do now is to look at focusing on doing some action at the end of this. So it's no good just having ideas. We need to implement them. And my formula there is decisions times actions times accountability, i.e. somebody's making sure you do stuff, equals results. Decisions on its own won't do. So what action can you take? I would suggest, on top of the notes you may have, as always, set aside time to work on your business. Most business owners work in the business doing the day-to-day stuff. Very hard to see how you can improve a business if you're just doing it every day. So try and get some time freed up where you just look at it as a director or a business owner to work out how other people can improve it by working in the business. And if you haven't seen it or read it, the best book on that by a mile is Michael E. Gerber's book called The E-Myth Revisited, Myth, M-Y-T-H. Still available on Amazon. That's probably the single best book to go through why you should be working on your business, not just doing the doing. Set goals, and we can help with that, and review the progress. So you don't just set goals or set plans and then file it. It needs to be a work in progress that you look at every day and every week. Nurture your customers. So, better customer service, keep in touch, understand and monitor KPIs. That might be slightly harder to do, but we're here to help with that. And then link the KPIs to team and business performance, and maybe even pay in terms of a bonus scheme of some sort, and put budgets, forecasts and processes in place. So not easy to do some of these, but the more of that you can do, the better it will be. Ways we can help. There's a few things that sort of link into this. We can pretty much help with any areas of business growth, but the ones that we can do at the moment, cash flow forecasts, I think they are essential, and increasingly some firms of accountants are only dealing with clients who will have these done yearly, because they then know that they're more likely to survive. So cash flow forecast, that's £800 to do a whole year, or sometimes 2 years within that figure. And that's then basically a really good tool to use to guide you through, but it also means you can very quickly tweak it to go, what if? Cash flow coaching, so looking at all the things we talked about today, we can do that monthly or quarterly. I think monthly is probably, certainly in the current crisis, more likely, and that's $240 per month. Or business planning, which is more general business growth stuff, which is a one-off of $480. That's looking at what type of customers should you deal with, how are you going to build them, etc. So all different things. Any of those we're happy to do, and I will be sending you out a form shortly after we finish today, just asking you what your plans are and whether any of those three things will be of use. We're also offering a 1-hour complimentary meeting just to discuss that in a little bit of detail. We won't be able to go into as much detail as the billable services, but we're here to help. So you can book up a 1-hour meeting to discuss cash flow or anything else for that matter, free of charge. I did say at the beginning that all of those things can be free. And some of you hopefully will have seen our emails and blogs, but there is now government funding for exactly this type of work. It's done by the Heart of the Southwest LEP, which is dealing with Devon and I think parts of Somerset. And it's effectively a grant of between 1 and 5,000, although they advertise that they expect it to be between 1 and 3,000 normally. Free money, so you don't have to repay it. There's no interest on it or anything like that. And it will, if you can make the case, it will basically give you money to do things like cash flow forecasts, to do things like KPI monitoring, etc., business plans, because the money's there to help you get through the current situation. So it's dead easy to do. I've done several applications for clients already. And if you're looking to do any services with us, we'll do the application form for you. It's not guaranteed to get through because they'll look at the best cases. So we'll try and make that the best case possible, but also it's first come, first served. So if you are interested in that, I would suggest you move fairly quickly. Quite happy to have a chat if you think it might be useful, but not quite sure what to do or what things to have. But all of those three things could be covered by one single grant. You could have the cash flow forecast, the business plan, and 6 months worth of coaching all paid for you just with the government grant if it's successful. And I would argue, even if they don't pay, those services generally will, pretty much be guaranteed to far exceed in profit and cash flow the costs. And in some cases, depending on the business, we will be able to guarantee that so that the fee is linked to success. Because a lot of consultants and coaches just go, it's this figure and we're going to do wonders for you. But then if you ask them if they'll do it on a success basis, they won't. We're quite happy to look at that on a case-by-case basis. So if you haven't looked at that grant funding yet, I would suggest that's probably a really good thing to do. I'll just check to see if there's any questions. Yeah, congrats, Mark. Lots to implement. A question there from Tracy. Let's just read that through. It just says, how can we plan if we don't know what the future is going to bring? Yeah, good point. But I think my answer to that would be, if things are changing, which they obviously will do, we've got lots of uncertainties. I think that means even more reason to plan, because you can then work out what things might change if events don't happen. If you know you're going to get 200 grand profit every year, then to be honest, planning isn't top of your list. The aim of planning is not to predict the future. If we could do that, then I'd be far wealthier than I am at the moment. So, planning is not about trying to accurately guess as close as possible what's going to happen. It's working out what's going to make things happen and then decide how that's going to vary. But also you can then start to go, well, after a month, these figures aren't quite where they should be. So what if the rest of the year looks like that? What's the cash flow going to look like? What's the profit going to look like? And that allows you to take action in the middle of the plan rather than wait till the end and go, did we get there? Because things will change. I think I quote at my meetings with clients, and if I've quoted this to you, apologies for saying it again, but it will highlight the answer to Tracy's question. Apollo 11, I think it was the first space mission to land on the moon. You would imagine that the plan for that was very detailed. There'd be huge manuals, computer programs, and there will be, hundreds of people basically back at base checking every single measurement and everything that's going on with that program. So very detailed, but their aim was not to predict the future. Their aim was to come up with a plan and then to see whether they were on plan and then tweak things whenever they realized they weren't. Because the plan was to land somebody on the moon safely and get them back to Earth safely. And they succeeded. But the interesting thing is that over the course of that whole mission, the amount of time that they were actually on plan, i.e. where they thought they were going to be, is 3%. So almost all the time, they weren't where they thought they would be. So how did they make it succeed? Well, they knew that they weren't where they were supposed to be, and they changed things to try and get back to where they were supposed to be. Far more chance of doing that if you're looking at it every minute than waiting till the end and going, did it land in the ocean successfully? Oh, no, it didn't. So, so I think that people get the wrong perception about business plans. They're not trying to predict the future. They're trying to go, if we do this, what happens? If that changes, what does it change for us? And if we don't get those things happening fairly quickly, what can we then do to try and get it back on track? So good question, and hopefully that will help a little bit. So I will send a form out to you, just basically asking what you're going to do next and offering the 1 hour free meeting if you want it. But I'd look very quickly and seriously at the grant funding available to you. It can be any form of consultancy, so it doesn't have to be cash flow just because that's today's subject. It can be sales and marketing. It can be growing profit, etc. It could be even exit strategy if that's what's needed. So as with all of these things, get started now, take those notes and do something with it immediately. Doing nothing is not an option in my view. So quick passing thought, which is basically from Richard Branson, who knows about these things. Never take your eyes off the cash flow because it's the lifeblood of business. So hopefully today we've illustrated that a little bit. I'll just pull up our contact details if you do need to get in touch with us. But as always, thank you for attending today. Really appreciate you coming along. Hopefully you've got some useful stuff out of today and you've got a long list of things to go and do. If we can help you with those in any way at all, please get in touch. And hopefully we'll see you at the next webinar, which we're aiming to be in October. So you will get normal invites and everything for that. So take care and keep safe, and hopefully we'll be in touch and involved with you shortly. Thank you.